Hello, everyone, and welcome to today's explainer. If you've ever stared at a set of financial statements and just wondered how on earth did a mountain of scattered receipts and daily sales magically organize themselves into this perfect balance, well, you are definitely in the right place. Today, we're demystifying all those rigid accounting rules by tracking the literal story of where a business's money actually goes. Okay, let's dive into this. So, where does a business transaction actually go? That's the big question we're answering today. Instead of just drilling dry textbook rules into our heads, we're going to follow the actual life cycle of a single business event. I want you to think of a transaction not as some boring number on a page, but as a living piece of data traveling through a very specific, carefully designed ecosystem. And here is exactly how that journey flows. First up, the transaction itself. Then, recording it in the journal, followed by posting it. Next, it moves over to the ledger, and finally, it lands all neat and tidy in the trial balance. It's a clear, simple path. So let's go ahead and take that first step. Section 1. The core books of accounts. Now, before we can even think about recording a single cent, we really need to understand the two primary tools in our toolkit. Those tools are the general journal and the general ledger. Now, what's really interesting here is how they work together. Think of the general journal as your daily diary. It's the book of original entry. It literally just writes down what happened today, strictly in chronological order, with all the debits and credits attached. The general ledger, on the other hand, is your book of final entry. Picture it like a giant, perfectly indexed filing cabinet. It takes all those random daily diary notes and organizes them by topic or by account, so you can easily see your running balances at a glance. Section 2. Finding your normal balance. So we know where we're writing. But to actually write in our accounting diary, we first have to understand the specific rules of the language we're using. And that starts with the normal balance. By definition, this is just the specific side, whether that's the debit side or the credit side, that increases a particular account type under our double entry system. But why does this actually matter to you? Well, because mastering this one little concept is literally your ultimate safeguard. It's going to help you instantly detect posting errors and guarantee that your trial balance actually balances at the end of the day. To make this super easy to visualize, just imagine every single account has a home side. Take a look at assets and expenses. They live over on the left, meaning their home side is the debit side. But notice how liabilities, equity, and revenues live over on the right. Their home side is the credit side. The absolutely golden rule to remember here is that anytime you make a deposit or you want to increase an account, you always do it on its home side. Section 3, recording basic journal entries. All right, armed with the knowledge of our home sides, it's time for the practical stuff. Let's actually record our very first transaction. Whenever you're making a journal entry, you've got to follow a pretty rigid anatomy. You need the date, the account you're debiting, the account you're crediting, the amounts, and a brief explanation, which we often call a narration. Think of this like writing a really short, highly structured message to your future self. Exactly who paid, what was exchanged, and where you should file this note later on. But listen, no matter what that short message says, it absolutely must obey one unbreakable law. So the crucial point is right here. Debits must equal credits. For every single entry you make in that journal, the financial effect has to keep the accounting equation perfectly balanced. If they don't equal out, you stop right there, literally put the pen down, because something definitely went wrong. Section 4. Visualizing with T accounts. Okay. Once we've recorded our beautifully balanced entry in our chronological diary, we have to actually move that data. We're transitioning from the diary phase right into that categorized filing cabinet phase we talked about earlier. To do this visually, we use a nifty thing called a T account. As the name suggests, it looks exactly like a giant letter T, and it's a visual tool that represents one individual account. It's specifically designed to help us compute running balances, trace transactions, and really grasp the mechanics of posting. And just like our normal balances, debits are always on the left, and credits are always on the right, no exceptions. Functionally, this T account is a lot like a simple two-column ledger sheet. For most accounts, you can just think of it as listing your inflows on the left and your outflows on the right. You post your journal amounts to the appropriate side, and then you just sum up each column. Whichever side is larger tells you your net position. If the debit total is greater than the credit total, boom, you have a debit balance. If the credit total is bigger, you've got a credit balance. Simple as that. Section 5, a transaction's complete journey. All right, we've got our maps, we've got our tools, and we definitely know the rules. Let's move to and see how this builds into a real-world scenario. Here is our starting point, our business event. We sold services for 10,000 pesos in cash. This is the raw, everyday reality of what happened today. Now let's process it through our ecosystem. Step 1, we go straight to our daily diary, the general journal. We jot down the date. Now, we know cash is an asset. Its home side is the left, and since we're getting more of it, it's increasing. So we debit cash for 10,000 pesos. We also know service revenue's home side is on the right, and it's increasing too. So we credit service revenue for 10,000 pesos. We add our quick narration, cash sale of services. Check it out, our debits perfectly equal our credits. The diary entry is complete. Next up, we physically post those numbers, moving them into their specific filing cabinets, the T accounts over in the ledger. Imagine taking that 10,000 peso debit and sliding it straight into the left column of the cash T account, which gives us a 10,000 peso debit balance. Then we grab that 10,000 peso credit and drop it right into the right column of the service revenue T account, yielding a 10,000 peso credit balance. This brilliantly illustrates exactly how raw data transforms into useful balances safely tucked away in their proper homes. And just like that, we've reached the end of the transaction's life cycle. Our golden rule held up perfectly. Debits equaled credits. Our cash asset went up, our revenue went up, and the books are in perfect harmony. We're now totally ready to pull these balances to prep a trial balance and eventually our full financial statements. To make sure your transactions always flow this smoothly, keep this super quick checklist in your back pocket. Number 1, always know your normal balances, those crucial home sides. Number 2, fiercely enforce the rule that every single entry's debits absolutely must equal its credits. And number 3, never ever skip a step. Always follow the natural chronological flow from the journal diary directly into the ledger filing cabinet. If you apply this exact flow, I promise you will never lose track of a transaction again. So as you look at your own bookkeeping or dive back into your accounting studies, I want to leave you with this thought. Can you trace every single peso in your business all the way back to its original diary entry? If you follow the journey we just mapped out today, the answer will always be yes. Thank you so much for joining me on this explainer, and I will catch you on the next one.